Hi, good afternoon. This is Meir Valensky with Driving Markets. Driving while talking about markets. Now, one of the things I want to add on here, if any trader or any investor needs mentoring or needs help or assistance or guidance into a platform, whether it's retail or institutional, then obviously be more than happy to help. You can contact me on this particular channel. I want to expand it and obviously begin to monetize the channel if at all possible. Anyhow, so moving forward, anything said in this piece is only opinion, not financial advice, not investment advice. Let's kick off. Let's see what's happening and see what is driving markets today and this week. So the big event this week is going to be on Monday and Tuesday with the FOMC, the Federal Open Market Committee meeting. That in essence is the central bank of the US, and they will be raising interest rates by 75 basis points. Odds on favourite. It'd be a real surprise if they don't, because it's already been discounted into the dollar and discounted into financial markets that they're going to be raising interest rates. They may do it by 100 basis points, an outside chance there of doing it, but I'm of the opinion that it's going to be 75 basis points, unlikely 100, but you never know. That's going to be on Tuesday and Wednesday. Now let's just discuss a little bit more the impact of that FOMC meeting. The real meat within the meeting is going to be on the Wednesday evening when Jerome Powell and the Fed come out with their statement on how they view the economy, how they view business, and how they view overall growth within the US and global markets. And that statement will be a clear guide as to where interest rates are going to go in the future. By the way, if the volume is low, I apologize. I don't have my earpiece on me, so hopefully you're going to pick up the sound. If not, it's going to be a pretty poor production. Okay, so as far as the meeting is concerned, Wednesday, we're going to wait for the statement coming out from the Fed, and that statement will give us a clear guide whether rates have topped out, peaked, as the market is expecting, or are they going to be more aggressive and as hawkish as they've been over the last few months? It's a possibility. We simply don't know at this moment. My overall view is that the interest rate rises are going to continue on an aggressive fashion well into 2023 because inflation is not under control. I've stated over and over again, inflation is not under control. You may have a drop in rental prices and properties, and that is one of the measures of inflation, but we also had a drop in oil and inflation still went up, which is a big concern for the central bank. And then on Friday, going ahead, if I fast forward in a couple of days, you've got a massive number out in the US, which is the non-farm payroll, which is the unemployment number, comes out the first Friday of the new month. And that unemployment number, again, over the last few months, has shocked markets and caused extreme volatility, and there will be further volatility around that number on Friday, with the dollar jumping around and equity market futures jumping around also. So take that into account. The number is expected to come in at around about the 380, 390,000 level. If it comes in higher than that, then you can expect markets to drop, or equity markets to drop significantly, and the dollar to jump. Markets will drop because that will just give another indicator that interest rates will be going up and inflation is here to stay. Now, looking at employment and consumer spending and full employment, those are some of the factors that are the furnace, they're the fiery furnace that keep inflation bubbling along. So when you have full employment, you've got the advantage of a growing economy, but you've also got the disadvantage of rising inflation, and that's going to have a further impact on the Fed's decision after Friday. So we've got Tuesday, Wednesday, and Friday. Looking overall, the markets have had a hell of a jump up recently. It is a bear rally as per usual. You can expect the markets to come off. We're not going to go into a bull market because we're still suffering from a severe tightening of liquidity, whereby money's been taken out of the market, interest rates are rising, and the bond buying program and the printing money program has come to an end, and therefore that is going to be put pressure on markets and equities where there isn't enough liquidity there, enough money flowing around to push them any higher. Looking at some of the stocks, well, Apple had a stonking results last week, 7% rise in the stock, all-time high on sales and revenue. I'm still a big seller of Apple. I've said all along, long term, not on a day trade. long term, Apple is going to go down unless they become innovative, and they haven't been, and it doesn't look like they are going to be, because they're happy to sit on their laurels and just cash cow and take as much money out of existing design telephones with no new innovation as they're doing at the moment. Elsewhere, Tesla is going to come under pressure as the cost of Twitter is going to bear down on Elon Musk and the financing of that deal. Twitter has been taken private. Elon Musk has fired the CEO and all the directors. That was expected, and he's now going to make it a free speech distribution channel, so effectively say more or less what you want on that particular channel and get away with it, which is fine. There's far too much political correctness these days, and a person should be able to express what they want. Looking on foreign currency, looking on foreign exchange markets, you're going to have continuing dollar strength going forward as fears of inflation rise. I can see the dollar going higher against the euro and against the yen, considering that the yen has got zero rate policies and the euro is well behind the curve on interest rates, so keep an eye on those. We're getting the pound, interestingly enough, there with Rishi Sunak in place, you could see the pound running up to 121, 122 against the dollar, and creeping up also against the euro and some other majors as stability returns, thank God, to the UK. Let's see what the budget says on the 17th of November, but you can expect the UK can expect for some serious pain within the budget. Regarding geopolitical situation, you've still got obviously the impact of Russia, Ukraine. That war's probably going to expand to other regions and other countries, and OPEC is looking to cut oil production even further in order to support the price of oil and keep it at around about the $90 to $100 a barrel level. That's what you're going to have on oil. Oil is going to creep up, and that's more or less it. Anyone, again, want to emphasize, needs any help, mentoring, any education institution needs any type of videos done on a daily basis, whether they're done for basic level or advanced level, more than happy to help. This is Meir Walensky with Driving Markets, talking about markets, in this particular case, while driving. Have a good day.